Welcome back, everybody. Ready to dive into another set of financials.
Absolutely. Always excited to see what we uncover.
Okay, well, today's deep dive was sent in by a listener, and it features EMS Limited.
EMS Limited. Interesting.
Yeah, and they specialize in water and wastewater treatment solutions.
Okay, water solutions.
So they're in the infrastructure sector, and they provide a full suite of turnkey solutions.
Turnkey, meaning they handle the entire process.
Exactly, everything from design and construction to installation and even operation.
That's pretty comprehensive, covers the entire life cycle of a project then.
It does, and they've got a pretty impressive capacity for their sewage treatment plants.
Oh, yeah. How much are we talking?
A whopping 80 MLD.
80 MLD, that's enough to serve a mid-sized city.
It is. So clearly they're not just dipping their toes in the water, they're really diving in head first.
I like that analogy, diving in head first.
So today we're going to really put their Q2 FY25 performance under the microscope.
Sounds good. What are we focusing on?
Well, we'll be looking at their key financials and ratios, kind of like a financial EKG to check the heart of their operations.
Okay, I like that. So things like revenue, EBITDA, those sorts of metrics.
You got it. We'll see how efficiently they're operating, how profitable they are, and really get a sense of their overall financial health.
Excellent. I'm ready to dig in.
Perfect. So let's start with the top line figure, their revenue.
All right, revenue, the lifeblood of any business.
For sure. And for Q2 FY25, EMS Limited brought in a pretty healthy euro 233 crore.
233 crore, that's a significant number. How does that compare to previous quarters?
Well, it's actually a notable jump, suggests they're on a solid growth trajectory.
Upward trend in revenue could be a sign of gaining market share or successful new services.
Maybe even both. Now, let's look at their EBITDA, which stands at 165 crore.
165 crore, that's a strong figure.
And what's even more impressive is their EBITDA margin, which sits at a solid 29%.
29%, that's really healthy. Shows they're keeping costs under control while generating substantial revenue.
Exactly, a sign of operational efficiency for sure.
Definitely. Efficiency is key in any industry, but especially in infrastructure.
Right. But revenue and EBITDA only tell part of the story. Let's look at their profit after tax, or PAT.
PAT, the bottom line. What did they report for this quarter?
It came in at 50 crore. Not bad at all considering their growing revenue.
No, that's quite solid. And it's important to consider alongside their revenue growth, right?
Absolutely. It shows they're not just growing, but growing profitably, which is a good sign for any investor.
Definitely a key indicator.
Now, this is where things get a bit more interesting. Their trade receivables, specifically their debtor days, are a little on the high side.
Debtor days, oh, that's how long it takes them to collect payments, right?
Yep. And they're sitting at 112 days.
112 days, it's over 3 months. That's a bit longer than you typically like to see.
Makes you wonder if there might be some issues with collections or if it's just the nature of the industry.
Yeah, we'll need to look at the trend over previous quarters to see if it's a blip or a cause for concern.
Good point. And speaking of potential concerns, their free cash flow, FCF, for the quarter is negative 9 crore.
Negative FCF. That's a bit puzzling, especially with those impressive revenue and EBITDA figures.
It is a bit of a head-scratcher. It could signal a few things. Maybe they're investing heavily in new projects.
Or perhaps expansion plans. That could eat into their cash flow in the short term.
It's not necessarily a bad thing, but it's definitely something we need to investigate further.
Agreed. We need to understand what's driving this negative FCF and how it aligns with their overall financial strategy.
Okay, I think it's time to shift gears and look at some key ratios to get a wider perspective.
Ratios. I love ratios. They can reveal so much about a company's financial health.
Right, well, first up, the classic PE ratio.
PE ratio, the price-to-earnings ratio, always a good starting point.
And for EMS Limited, it currently stands at 26.1.
26.1, what does that tell us?
It suggests that investors have a fairly positive outlook on their future earnings potential, willing to pay a premium for each rupee of earnings.
Okay, so the market seems to be optimistic about their future prospects.
They do. Now, here's something that caught my eye. Their debt-to-equity ratio is incredibly low, practically non-existent.
Wow, debt-free. That's almost unheard of in the infrastructure sector.
It's a remarkable feat. Gives them a lot of financial flexibility and makes them less vulnerable to interest rate hikes.
Absolutely. They have the freedom to maneuver and invest without the burden of debt. That's a significant advantage in today's market.
It's like they have a financial superpower.
They certainly do. But remember that negative free cash flow. Could their debt-free status be a sign they're being overly conservative?
That's a good point. Are they missing out on opportunities to leverage debt for faster growth?
It's a tough question. While being debt-free has its perks, there's always that risk of being too cautious.
It's all about finding that sweet spot between risk and reward.
Exactly. And to really assess that, we'd need more information about their growth plans and capital allocation strategy.
Agreed, context is key.
Always. But it's definitely something to keep in mind as we continue our analysis.
Absolutely. So let's move on to another important ratio, the PAT to CFO.
PD to CFO. That's profit after tax to cash flow from operations.
You got it. Helps us understand how much of their profit is actually turning into usable cash.
Essentially, it's a measure of earnings quality. A higher ratio usually means profits are converting well into cash flow.
So what does EMS Limited's ratio look like?
For EMS, it stands at 0.21.
0.21. What can we infer from that?
Well, it suggests that while they're profitable, not all of those profits are immediately turning into cash.
Okay, so there's a bit of a lag between when they record the profit and when they have the cash on hand.
It could be due to the nature of their projects. Large-scale infrastructure often involves staged payments.
So it's not necessarily a red flag, but more of a yellow light, something to keep an eye on.
Right. We need to see how it evolves over time and understand the reasons behind this lag.
Makes sense. Now, how about their asset turnover ratio? What did you calculate for that?
Their asset turnover is 0.36.
0.36. So for every rupee invested in assets, they're generating 36 pays in revenue.
Exactly. And in their case, considering their focus on large infrastructure projects, a lower asset turnover might not be a bad thing.
Why is that?
Well, large-scale projects often have longer gestation periods, so the revenue generation might be spread out over time.
So it's not just about how much revenue they generate, but also about the timing of those revenue streams.
Precisely. We need to consider the project lifecycle and associated cash flow patterns.
I see. So we've covered quite a bit so far.
We have. We've seen impressive revenue growth, healthy profitability, but also some questions about their cash flow.
It's like they're juggling a lot of balls in the air: growth, profitability, cash flow. The key is to keep them all in motion.
A perfect analogy.
Yeah.
So where do we go from here?
Well, I think next we need to try and connect all these dots, look at how all these pieces fit together.
Absolutely. Let's see if we can uncover the underlying story and paint a comprehensive picture of EMS Limited's financial performance.
Sounds like a plan. Let's get to it.
All right, so let's start connecting the dots. What do we have?
Well, we've seen their impressive revenue growth, a healthy EBITDA margin, and they're definitely turning a profit.
Yep.
But those extended debtor days and the negative free cash flow, those raise some questions about their short-term financial stability.
Yeah, for sure. It's like they're doing well, but they need to keep an eye on those cash flow dynamics.
Exactly. Now, how does their almost non-existent debt fit into all of this?
Well, it gives them a lot of flexibility and resilience. They can weather economic storms better than companies drowning in debt.
Yeah.
But are they being a little too risk-averse?
Right. Could they leverage debt strategically to accelerate their growth?
It's a classic dilemma many successful companies face, playing it safe versus embracing risk.
It all comes down to their long-term vision and how much risk they're comfortable with.
And we can't forget about external factors, the competitive landscape, regulatory changes, and the overall economic climate.
All of that can impact a company's strategy and performance. It's like sailing a ship. You need to adjust your sails based on the wind and currents.
That's a great analogy. Speaking of performance, let's look at those impressive ROCE and ROE figures.
29.3% and 22.9% respectively. Those are some eye-catching numbers.
And they are. They're indicators of how effectively they're using their capital and assets to generate profit.
But the question is this level of performance sustainable?
That's the million-dollar question for any investor to maintain this. They'll need to keep winning those profitable projects.
And manage those cash flow challenges we talked about.
Exactly. They need to ensure their financial engine is optimized for the long haul.
Okay, last but not least, let's touch upon their asset turnover again.
Right. It was 0.36, if I remember correctly.
You do. Now, considering their focus on those large infrastructure projects, what can we infer from that number?
Well, in that context, a lower asset turnover isn't necessarily a red flag.
How so?
Because those projects often have long gestation periods, meaning they invest heavily in assets that will generate revenue over an extended time.
Oh, I see. So it's not just about how much revenue they generate, but the timing of those revenue streams as well.
Precisely.
All right, I think we've covered a lot of ground today.
We have. We've gone through their impressive revenue and profitability and also touched upon those areas that require attention, like their cash flow management.
It's clear that EMS Limited is a company with a lot of potential, but they also need to carefully navigate those financial currents.
I completely agree. It's a fascinating case study that really highlights the complexities of analyzing financial performance.
It's like piecing together a puzzle. And looking for those connections to get the bigger picture.
And sometimes those missing pieces are the most intriguing ones.
Well said. So where do we go from here?
I think the next step is to really dig deep into their financial statements, particularly their cash flow statement.
Okay, to get a clear understanding of what's driving that negative free cash flow.
Exactly. And we should also examine their debtor aging schedule to assess the potential risks associated with those high debtor days.
Sounds like a plan. Okay, so we've essentially done a financial x-ray on EMS Limited, right?
We have. We've seen their strengths and highlighted some areas where they could potentially improve.
So if someone came to you and said, hey, I'm thinking about investing in EMS Limited, what would your key takeaway be?
That's a good question. I think I'd say EMS Limited is a company at a crossroads.
At a crossroads. Okay, interesting.
They have a lot going for them. Strong revenue growth. They're profitable, virtually debt-free.
But
Those cash flow challenges we discussed, those high debtor days and that negative FCF, those could hinder their ability to capitalize on future growth.
so they're performing well, but they need to tighten up their cash flow management to really stay ahead of the game.
Exactly. It's a balancing act between pursuing growth and maintaining that financial stability.
It's like building a skyscraper. You need a solid foundation to support those soaring heights.
I like that analogy.
Now, with their strong financials and impressive performance, could EMS Limited be a target for acquisition?
It's definitely a possibility. The infrastructure sector is seeing a lot of M&A activity.
And a company with their track record, their expertise, and their clean balance sheet, that's attractive, right?
Very attractive. They'd be a valuable asset for a larger player looking to expand in the water treatment market.
It's like they've made themselves a prime target.
Perhaps. But ultimately, the decision to stay independent or explore acquisition opportunities, that's up to their leadership and their long-term strategy.
Well, it's definitely a dynamic situation that we'll be keeping an eye on.
For sure.
So as we wrap up our deep dive into EMS Limited's Q2 FY25 performance, I think it's safe to say they're a company worth watching.
I agree. They're making waves, but they need to navigate those financial currents carefully to really reach their full potential.
Couldn't have said it better myself.
Yeah.
So for anyone listening who wants to learn more, where should they go?
I'd recommend checking out EMS Limited's annual reports and investor presentations. There's a wealth of information out there.
That's always a good starting point for sure.
Definitely. And remember, informed investors make the best decisions.
Absolutely. So keep exploring, keep learning, and until next time, happy investing, everybody.
Happy investing.